I wanted to move into our next panel. We have an economic outlook and industry performance. These will be presented by Bob DiChiara. Bob is a New York Regional Manager of the FDIC's Division of Insurance and Research, a proud resident of the city of New York City. And Daniel Grantham, who is Senior Financial Economist in the OCC's Economic and Policy Analysis. You can look at their bios and review some of their highlights of their distinguished careers. So Bob and Daniel, I'll turn it over to you.
Great, thank you very much. I can honestly say I've been called a lot of things in my life, and distinguished is not one of them, so I appreciate that warm introduction. Bob, if we can go ahead and go to the next slide. My name's Dan Grantham. I'm from the OCC. My co-presenter today is Bob DiChiara from the FDIC. Just a standard disclaimer that we always provide. You know, the views that we express today are our own and do not necessarily reflect those of the agency. So with that little housekeeping item out of the way, we can transition to the next slide. So what are we going to talk about today? We've got three main areas that we like to touch on. The first is the general economy, which has recovered quite a bit from where we were 1 year ago. We're going to talk about higher inflation, whether we think that is a temporary phenomenon or something that could potentially be more persistent. We'll transition and talk about residential real estate prices. As Chairwoman McWilliams mentioned, that's something that we continue to monitor both at a national level as well as regionally. And then finally, we're going to touch on commercial real estate and some of the loan performance, particularly among the mutuals. So with that, if we can transition to the next slide. And, you know, the two main things that we look at as economists to gauge the health of the economy is one, real GDP. So the amount of goods and services that are produced in an economy in a given year. And the second is the unemployment rate, or the percentage of those people who are out of work that are actively looking. And one of the metrics that we use to look at future economic performance is the blue chip consensus. Now, that's simply a simple average of 50 prominent business economists and gives us an indication of where they see the economy going. And at least for the full year 2021 and 2022, economic growth is expected to be quite robust. In fact, if it comes to fruition that it's 6.7%, that would be in excess of any year that we've seen since 1984. So quite robust. And the blue chip is done on a monthly basis. And each month since last December, the blue chip has actually increased their estimates for 2021. And generally when they do that, they pull forward some of the growth from the second year out, or 2022 in this case. But for this forecast window, what we've seen is that they've increased the expectation for 2021 and actually increased 2022 as well. Now, the labor market, which we'll spend some time talking about in a little bit, has recovered quite a bit, but there's a lot of interesting anomalies that we'll talk about that I'm sure you all are seeing on a regional basis as well. But if we can transition to the next slide and talk about why we expect GDP growth to be so pronounced. You know, we've seen a tremendous amount of stimulus pumped into the economy, as the acting comptroller Stu mentioned. And along with that, we've seen a decrease in consumption. So three charts here kind of lay out the story. The first being on the far left, looking at a decomposition of real personal incomes. So we break it out by four large buckets, and the solid black line represents the pre-COVID income for the US. And actually during this recession, we saw household incomes increase quite a bit. Now they increased because of the unemployment insurance, that supplemental $600 for a good portion of last year. Currently it's $350. Some states are backing out, but the entire program is supposed to sunset by Labor Day of this year. Now, the green bar represents those one-time stimulus payments. So we take that collectively, real personal incomes were up quite a bit. Now, at the same time, because we had the economy shut down, we have a lot of stay-in-place orders. COVID-19 was raging. the ability to spend, particularly on services, decreased dramatically. So the center chart tries to lay out the amount of spending that didn't take place that potentially would have if we followed a normal trend. So about $1.1 trillion wasn't spent last year that we would have expected to be spent. Now, so we've got an increase in personal incomes, we've got decrease in consumption. What did Americans do with this? Now, as the chairwoman mentioned, we saw a dramatic increase in deposits. So the Fed tracks household cash holdings in checking and savings accounts, and we saw a dramatic increase of a little more than $2 trillion funnel into the banking system. So the expectation will be that consumers have this large amount of money in savings that's sitting in cash that they're ready to deploy as economies reopen. Now, one of the interesting facets of this recovery is kind of the differentiation we've seen regionally within the labor market. In the next slide, we touch on some of that disparity. So more broadly, the labor market has really lagged the general recovery. 48 of the 50 states remain below the employment levels that we had in pre-COVID or February of 2020. Now, those states that are demarked in red are where we've seen the largest amount of unemployment loss still today. So the U.S. overall is about 5% fewer people that are employed today than in February of 2020. But Nevada, New York, areas in the New England, where we do have a lot of mutuals, are actually seeing more pronounced economic stress, particularly in the labor markets. Now, one of the fascinating things about this that we've seen is that while we have unemployment be lower than where we were, we have a record number of job openings, which we touch on in slide 11. So, you know, how do we decompose, or how do we think about this juxtaposition where we have 8 million people fewer working today than we did, but we have over 9 million job openings? You know, there's a lot of theories that have been bandied about. One being that the industries that were hit the hardest, particularly leisure and hospitality, have some of the lowest average wages of all industries, and the generous unemployment insurance has actually allowed a lot of them to make more money staying at home than working. We've seen job quits, particularly among leisure and hospitality, be a lot stronger. Although the expectation will be, as these programs sunset, and at least on a national level, they'll all sunset unless there's any sort of legislative action by Labor Day, we would expect to see employment reach full capacity in the coming months, certainly by the fourth quarter of this year. Now, the rapid recovery that we've seen in terms of personal income, spending coming back a little bit, and the expectations for strong rebound in the second half of this year has really raised the prospect for, could we see a dramatic increase in inflation? And the next slide, slide 12, presents both the consensus forecast and one of the preferred measures that I like to look at, the Treasury break-even rate. And the one on the far left goes back all the way to 1960, and it looks at the year-over-year percent change in personal consumption expenditures. And it strips out energy and food. So this is the Fed's preferred measure of inflation. And the lighter blue area represents the blue chip consensus. So there is an expectation that prices will increase and then subside to around that 2% level. But I wanted to put it into the longer historical term, you know, to see, you know, what persistent and high inflation really is. You'd have to go back to the 70s and 80s. You know, what we're seeing today, the idea being is it's more driven by temporary factors. Another metric to kind of gauge where we expect inflation to go is using this Treasury break-even rates. I like looking at that because it's observing two market factors. It's looking at the nominal yields on treasuries and the Treasury inflation protected securities. So the difference between that would represent the break-even rate, and is really the market's expectation for inflation over 5 and 10 years. And that's definitely increased over the last year and a half. But still, looking at that overall level of between 2 to 3% is well within the Fed's target inflation rate. Now, slide 13 tries to put into these factors together and kind of talk about the factors that could potentially lead to inflation being more persistent and causing trouble versus the more temporary. For those that are suggesting inflationary pressures to be more persistent, if the economy were to begin to overheat, we do still have a lot of stimulus that's coming through that could potentially lead to issues. But, as we track prices, a lot of it seems to be more transitory. So, the base effects, or we measure inflation on a year-over-year percentage change. So prices actually fell during the depth of the COVID crisis. And when we measure it from April to April, prices look like they're higher than they were. We also have a lot of supply constraints that were caused by bringing the economy back online. So the general consensus, at least for the mainstream economists, is that we will see a blip in inflation. It's expected to be transitory, or other words, temporary, and return to that 2% to 2.5% level that the Fed is much more comfortable with. So with that, if we can transition to the next slide, and we'll pivot a little bit and talk about residential real estate. So if we go to slide 15, and as the chairwoman mentioned, we've seen a tremendous amount of home price increase over the last year. Depending on which home price index you look at, the one we're presenting here comes from Black Knight. We've seen double-digit home price appreciation. And if you look at on a county-by-county basis, 3,000 counties in the U.S., all but 4 have registered year-over-year growth. So we've seen dramatic increase in home prices that have been quite widespread. So the map on the right presents the county level increase in home prices, and those darker blue areas are where we see the faster home price appreciation. Now, the natural question is this a bubble? It's a dirty word. Are these prices sustainable? And let's go to slide 16 and touch on some of the underlying issues or fundamentals that I think have supported home prices over the past 5 to 10 years. One of the important issues is demographics. And I apologize, it's a little hard to see, but the chart on the far left looks at the U.S. population by age. And we're comparing the 2006 period to 2020. And if we look at the shaded blue area, we are in a period where there is a surge in the typical first-time home buyer age, so ages 26 to 34. It's a large increase in that demographic space. And if we compare that to 2006 during the last housing boom, there was actually a dip in the prime first-time home buying age. So we have an increase in demand from first-time home buyers that wasn't there previously. That's certainly boosting demand and prices over the last decade. We factor on to that housing supply. So if we move over one chart, 2 from the right, look at annual housing, and we look at it over a long-term trend going back to 1970, you can see really since the financial crisis, there's been underbuilding across the U.S., roughly about 5 million units, depending on how you measure the average trend. So we have an increase in demographics. We've got a decrease in supply. I mean, as I know, a lot of you that are active in the commercial real estate, particularly land development, most of these homes that are being built are on the higher end. A lot of the entry-level homes we're not seeing built, which is another reason we're seeing home prices increase. Third factor that's supporting home prices is interest rates. Interest rates have been declining for the past 30 years. And it makes a big difference in terms of what percentage of your income goes towards supporting your principal and interest payments. Now, finally, the last issue I think that's important that Chairwoman McWilliams mentioned is financing remains pretty strong. The underwriting metrics, credit score, debt to income, loan to value, fairly conservative. And the types of loans that are being originated are almost all 30-year fixed rate. No payment shocks, nothing exotic. All things that I think are going to longer run fundamentals that are supporting the housing market. If we go to slide 17, there are a few short-term factors that I think are really juicing home prices in the short term. And on the far left, looking at the median family income and comparing that to the median family home price. Now, I indexed this to 2013 for both series. So generally speaking, the red and blue lines on the far left kind of tracked each other. You know, they deviated during the last recession, and we've seen some deviation over the last year where while incomes still increase, remember we had a massive government stimulus, we've seen home prices grow much more faster than income, which in the long run would be unsustainable. But over the same period of time, we've had a dramatic decline in interest rates again. And what that really does is allow borrowers to stretch their current incomes because they're paying less in interest expense than they otherwise would have. So if we look at the payment to income ratios that we're not seeing a dramatic rise in that. So while borrowers are spending more money to buy a house, they're not using greater shares of their incomes to do so, which we think is good for sustainability going forward. And then the other main factor I think that have really boosted home prices over the last year is just the lack of available for supply that's for sale. We're near record lows, as you can see in the chart in the bottom right. Now, on a regional basis, a county basis, again, if we go to slide 18, I think the real takeaway story here is that the low mortgage rates are really making housing more affordable. And what we present here is on a county basis. We looked at going back to 1992. So for each county, we tracked the median family income in that county. We looked at the median home price in that county. And we asked if borrower put down 20%, bought the median family priced home using the median family income in that county, what percentage of their income would go towards making their principal and interest payments. And so what we look at on a quarterly basis over this 30-year period is trying to see each county compared to its own history. Where are they? Are borrowers that are entering the market, are they using more or less of their income to meet principal and interest payments? And those green areas are where we're seeing affordability be better than its historical average. There are some areas where we're seeing some red. These counties are generally smaller. On the West Coast, we are seeing more in line with average history, so closer towards that edge. But predominantly speaking, because of these lower interest rates, borrowers are able to at least meet their current mortgage payments on a going forward basis. Now, what does this mean going forward for prices? On slide 19, we look at forecasted home prices by a couple of the larger providers. And the expectation is that home prices will peak this year and then subside. So the argument being that what we're experiencing currently is this future home price appreciation from what I mentioned, the longer run fundamentals that are supporting home prices. So home prices in 2022 are being pulled forward to today. So the expectation at least is that home prices will spike this year, remain positive in 2022, but be below where they were in terms of general trends. So with that, I'd like to turn it over to Bob, who's going to be talking about commercial real estate and some of the performance within the mutuals themselves. So Bob, take it away.
Great, thank you, Dan. So we'll continue a little bit with the residential story. I know, the residential lending landscape is support to so many mutuals, but shift over to the credit side and the performance of loan portfolios. Here we're showing, residential mortgage delinquencies have quote unquote soared. In some cases, Acting Comptroller Sue talked about headline numbers versus under the covers. We would just like to kind of show here a number that you may have seen in the popular press. This is Mortgage Bankers Association residential mortgage past due. They certainly have reached very high levels, are coming down recently, which is a good thing. There's some differences in the data. You'll see here the mutual banks have reported, continued very low, just like the rest of the banking industry, very low delinquency rates in terms of overall loan portfolios, and here in particular residential mortgage portfolios. So the difference here in the data, mortgage services are reporting their data on loan count. So you'll see this number potentially, in the headlines. This is, the number of mortgage holders that would be past due according to servicer reports, rather than the loan balance. Another part of the difference here is that the mortgage servicers, which the Mortgage Bankers Association uses for data, is reporting the forbearance loans according to their payment status. So continue to show delinquent rather than the forbearance showing they're not delinquent. So if you look at the two different numbers, we like to highlight for folks that you might be having a different experience than you see in certain headline numbers. So when we look about what's coming due in terms of the credit story, the forbearance story shows that this month and continuing for the rest of the summer is where you're going to see a bulk of the forbearance plans expiring, so to speak. There has been some extension at the federal level for rental payment forbearance, forbearance for loan payments. This is the schedule of expiration. So what's going to happen here in the next few months is there'll be decisions on whether they continue with a forbearance plan or come out of forbearance and come back to a payment performance plan. So we are seeing the total amount of loans in forbearance and delinquent coming down, but they are moving into the later stage delinquencies, and that makes sense as folks have availed themselves of the forbearance plans available. Less are coming into delinquency and forbearance, but they're migrating to maybe more past due, in terms of moving from like 30 over to 90 plus past due. But certainly the total amount coming due reducing is a good thing. So when we look at the impact on the industry, as I mentioned earlier, residential lending, very important asset class. It's on average about 300% of capital for a mutual bank. It's only about 120% for non-mutual institutions. This contributes in part to the lower net interest margin for mutual banks. You can see on the left chart, margins are down along with the rest of the banking industry. This is a function of a few things. First, liquidity up significantly as surge deposits came into the banking industry. This pushed liquidity up for insured institutions, mutuals included, lower yielding assets, so that's putting pressure on the NIM. Funding costs also bumping along, the bottom could only go so low, so that started to crimp the margin, as well. Also a function of the interest rate story. Long rates still very low, although the 10-year has increased somewhat in recent months. But the spread between the 30-year mortgage, and Dan mentioned earlier how that's increased affordability. That spread with the 30-year mortgage and the 10-year has narrowed quite a bit. So it's ranged during the pandemic from about 130 to 160 basis points. Pre-pandemic, it was well over 200 basis points. And this really affects the optionality, right, of the major asset class for mutual institutions. And I'm showing on the right how significant and how massive the refi demand has been. So this optionality for a large portion of the balance sheet for mutuals and other community banks and other banks that hold long-term mortgages has reduced the benefit, right, of being able to hold longer-term assets. When rates decline, you get that benefit. But with the borrowers having all the option here with refinancing and the activity being so significant, we're seeing that that margin compression continue for mutuals. We thought it was interesting if you look back to during the crisis period, let's say first quarter 09 through 12, the margins for mutual banks sort of outperformed, because when you had the drop in interest rates following crisis, those long-term assets supported some benefit to margins. But that was against the backdrop of a much more modest refinancing landscape back from 09 to 11 and 12, as you can see on the chart on the right. So this refi wave continues to be a headwind for the margins of mutuals and banks overall. We talked a little earlier about commercial real estate. And while residential is still the largest lending class, commercial real estate has certainly grown among a portion of mutuals. Here we're showing the median concentration, so commercial real estate loans divided by capital for two different sets of mutuals, the smaller mutual banks and the larger. And you can see CRE growth has been elevated among the larger mutuals, particularly since 2015. A fair chunk of this, about half, is driven by the multifamily space. So that sort of coincided with increased demand for multifamily. Apartments were certainly a big asset class, growing in scope from coming out of the crisis in 2012 through into the pandemic. As you might imagine, a lot of these mutuals that have increased their multifamily exposure are in proximity to major markets, many in the Northeast, New York City, Boston, and Washington, D.C. In particular. So as part of commercial real estate, multifamily has become an increasing part of the landscape, and that makes the performance of the apartment rental market of particular interest to many of us. You'll see on this slide, we're showing the payment performance data. This comes from the National Multifamily Housing Council. This data has increased in its popularity, as you can imagine, during the pandemic, as it was monitored quite closely. You can see here, this is the share of apartment renters making at least a partial payment of rent during the first week of any given month, and then by month's end. And while it did decline early in the pandemic, it has held up reasonably well. There certainly has been more stress at the lower income geographies in terms of rent payment performance, but overall this has held up pretty well. This data might be of interest to some folks. It's released on the second business day after the 6th of the month, so you can get that first week of payment performance, and then they update it during the month. This covers about 11 million professionally managed apartments in the data set, so you can get a good sense of what's happening at least nationally. Another part of commercial real estate, and I know we'll leave a little bit of time for questions. When we started to think about what early in the pandemic, what were going to be the asset classes in commercial real estate that got hit first, and our paradigm was certainly hotel and retail first, and that made a lot of sense. Those are assets that reprice almost the hotel at least reprices every night, you could argue, and retail with the pandemic and shutdown impacted right away. So as time has gone on, we're starting to look at what's the next phase of the commercial real estate industry, what's it going to look like going forward, and the office sector naturally is an area of focus for us. So the chart on the left, we thought it was interesting to show you. This is the share of a space in a given market, and we've picked some of the larger markets in the United States. How much of that space has been put back on the market for sublet? You may have heard some stories in the news about large tech firms giving back space that they no longer need, moving to a hybrid work model. And you can see the San Francisco market, it really has the lead on everybody else in terms of available sublet space. So this naturally puts downward pressure on rents, increases availability, increases vacancy. So this is something that we want to watch going forward. And when we talk about the long-term megatrend, if we think about what does this mean for office space, there was discussion earlier about what it means for major U.S. cities and how much telework is going to impact the demand for office. There are many studies out there and surveys of companies of asking them how much space you're going to need in the future. This is a study from last year that generally said they're going to need a little less or a lot less. This was a survey of about 171 CEOs. There have been many studies since then. Some are showing they're going to return to the office a little bit more. Some are showing, continued use of a hybrid model. I think the jury is still out on what this is going to look like. I think companies are going to figure out for themselves what works for them and what's in the best interest of their company and profitability, commercial real estate as a cost center, but also having folks in the office for collaboration and what that means for the culture of an organization. So looking forward to a few themes that may play out in the next year or so. I think you'll likely have in the office market this emergence of a third option for work, not home, not in the office, but in a public area. I'm sure most of us at some point have worked from a cafe, and there was a story even yesterday about a restaurant in New York City this really shows you the stress that restaurants are under in New York City, going to a model where they'll let you work in the restaurant all day for, I think it's $25, and they'll watch your computer when you go to the bathroom or get something to eat or want to move around. But they'll lease you the space out, even out on the street when the weather is nice, to be able to work there. So emergence of this third sort of model may be sooner rather than later. Looking at B-class space that arguably could be less able to navigate all of the technological and health safety standards that are going to be needed if the industry decides, hey, we're going to keep people further away, but we're going to bring them back more. I believe there's probably going to be less of that and more sort of a distributed workforce and hybrid model of working from home and going to the office. But there are some buildings that may be less able to do that. Large cities, certainly we watch, they're more reliant on public transit, so they may be more likely to experience stress going forward. And then finally, you haven't seen a lot of stories about if vacancy rates, skyrocketing. Certainly occupancy, folks haven't been working in the office, but companies are still paying on leases and so forth. That's largely a function of the term of the leases. So we haven't seen all the strain and what the dynamic is going to look like in the office market because of the long-term nature of leases. I mentioned earlier, a hotel lease arguably is nightly. Office leases typically 5 to 10 years. So we think that's going to take some time to play out over the coming years. Vacancies have increased in office relative to other property types. So it is something that we want to be mindful of going forward. So I know we have about, I think about 10 minutes or so before our break. I thought we'd leave a little bit of time for questions and we can look at the Q&A. And I think Marianne Hathaway on our side is going to take a look at the Q&A and see if there are questions for us.
Yeah, Bob, hi. And I just want to remind the participants, if you've got a question, please place it in the Q&A. And, I'll start with the first question, Bob. You mentioned, or Daniel, whoever you think this is correct. When the pandemic hit, certainly hotel space was definitely top of mind. As a bank examiner and supervisor, this was not a sector that we had our eye on. So this was one that was a unique challenge. I shouldn't say unique, but an unforeseen challenge for us as bank supervisors. And what we saw was, even in the early days, maybe not the very early days, but as the first few months started to unfold, there was definitely an unevenness in the performance of hotel space. And if you had a loan to a mom and pop on the side of a highway, for instance, you still had workers that had to get through. You still had supply truck drivers and things that were still staying in those types of places. But convention centers were hit very, very hard. I just am wondering if you have any insights on sort of the recovery of that sector and how is that playing out?
Yeah, I can start with that, and Dan, if you want to jump into certainly the extended stay, sort of the hotel class that you're mentioning ran outperformed. They all had a drop in vacancy April, May, and June of 2020, without a question. Those have come back more quickly. Certainly the convention space, the luxury, those that cater to more corporate travel have lagged, although they have recovered. At one point, vacancy was down in the 15-20% range at the worst. It's come back into the 60s and 70s for even a little bit higher for extended stay. The corporates and the luxury are more in the 50s. This is data, if others are interested, we could pull up. I don't have a slide handy on it now, but there has been a lag in the recovery, certainly for the gateway markets and the luxury and the corporate, which are more attuned to business travel.
Dan, I don't know if you had anything further to add.
No, I think Bob covered it quite well.
Okay, great. So I know Marianne has a question in the chat that she'd like to pose to you guys. So Marianne, why don't you go forth?
All right. So Bob and Dan, thank you so much. I think it's been a great conversation. And so we've talked about the hotel and your views of the hotel outlook. What about malls and other retail? And we hear about repurposing. We're starting to see that, but I think all of us driving around can see a number of vacancies as well, too. And what are your thoughts? We all are reading the headlines, but what do you think? What would your kind of consensus be? And Bob, we can start with you.
Sure, I can take that. So you talk about repurposing, and I tend to think of it, sometimes falsely, as, oh, they can just repurpose it into something else. That is, depending on the property, can be a major undertaking and a major cost center for a purchaser of a distressed property like that. So certainly there's retail and there's retail, right? There some of the suburban malls and the ex-urban malls, they were already underperforming before the pandemic. And if you think about the mall space, we follow the aggregate industry trends, and there's about 1,200 malls nationally, and 22% of those account for about 3/4 of sales. So the other 3/4 of malls are fighting for the final quarter of sales. So those are the malls that were underperforming before, are likely to continue to underperform depending on the degree they can be repurposed. I know anecdotally, a lot of repurposing that was happening before the pandemic was moving from a place where you go to buy something to a place where you go to experience something. So moving from purchasing home electronics or whatever that might be to an experience like a restaurant. You might laugh, but trampoline parks were very popular in terms of transitioning some land into those types of experiences. Community college space, medical office was also something that was a destination for some of these properties to be turned into. But during the pandemic, no one was doing that. So the degree to which those experiences can come back and be part of this conversion story, I think that's what you're going to see. You're going to see some up, but it's not an easy undertaking, and I have to imagine there's some stress along the way as that transition happens. But overall, retail was the ex-urban mall. I would highlight as the most under stress, was happening even before. Dan, I don't know if you have anything to add.
No, I think you covered it quite well, Bob.
Thanks very much. And again, whoever wants to take this question, if you had a chance to review last year's FSOC annual report, Financial Stability Oversight Council, and I know we have mutuals as our audience, but I really recommend all bankers read those reports, and I've been involved in all of them, and it really does tell a story about the resilience of our economy. But as we were preparing that report, I like to say it's not. You look from 2010 and things started getting better, and then it sort of became, okay, this is sort of more of the same, but last year's obviously was quite different. And one thing that really struck me in the real estate market, which, I'm aware of, obviously, doing the work I do, but people forget is how much non-bank players do play in the CRE space. And at the time, we saw some weakness in some REITs, some commercial real estate REITs, and some CMBS, and particularly ones that were focused on one class of real estate. Can you tell us if you have any updates on how those sort of non-bank players are faring as things, at least in the banks, appear to be improving? And I see Dan looks like he's buffering a little bit, Bob, so perhaps.
Sure. Sure, I could take this. So certainly in the CMBS market, we saw a rapid increase in delinquency rates across the property types, mostly hotel, retail. The others, bumped up early in the pandemic in terms of delinquency, like multifamily and office, but not nearly to the degree that hotel, lodging, and retail experienced. So there were significant delinquencies during the course of the pandemic. Those have improved somewhat. So but you still have the hotel, retail asset class within CMBS underperforming the rest. Industrial has been sort of the darling where there wasn't any, and in fact, there was a tailwind for industrial in the CMBS market. Our banks, community banks in particular, have held up their market share pretty well in commercial real estate, less so in the construction market, but you talk about non-bank players being involved. Certainly the agencies in the multifamily space have grown dramatically. Our FDIC insured institutions market share in CRE is about 50% or so, and that's been fairly stable over the past decade. But certainly with respect to strain, it's really been somewhat narrowly focused in those two property types, hotel, retail, and lodging, and even those have improved somewhat in recent months.
Thank you very much. Dan, do you have anything to add to that?
No.
Great, thanks very much. One other question has come in about, and we just have time for one more, is the housing market. I don't know if that's maybe not your area of expertise, but what about the potential for bubbles and cliffs? And we talked a little bit, if you saw the chairman and the acting comptroller, she was talking about her neighborhood, which is like many of ours, where even a small house is receiving multiple bids over the asking price. And I don't know what your thoughts are on that, about, like I said, cliffs, bubbles, and the overall strength of the housing market.
Sure, I'll take a stab at that. I think all of us are kind of watching and experiencing in our own local markets. Washington, D.C. is certainly no exception. Generally speaking, even if you look at the literature for what a bubble is, going back to Robert Schiller's famous paper, you buy with an expectation that prices are going to continue to increase. I think for the most part, there's some long run trends that are supporting home prices, and there's some weird anomalies today that are also supporting home prices in the short term. There are not enough houses on the market for sale. To have the market clear, either people have to put their houses on the market to sell them, or prices have to go up. We're seeing prices go up. I think the general expectation is that home prices will peak this year and then subside next year. So, I think there are some strange aberrations in today's market. One of the things that we're not seeing an increase in terms of properties come on the market is we've had a foreclosure moratorium. So there's some homes that are out there that are artificially being kept off the market. So, it's something that we're watching, we're monitoring. But when we look at home prices, at least from an economics point of view, can the median borrower in an area with a median income step in and purchase a home? What percentage of their income has to be devoted to servicing that debt? And what we're seeing there is that home prices are actually quite sustainable because of the low interest rates. It's not an area where we have in 2006, 2007, where we have a lot of non-traditional mortgages, teaser rates, interest only, negative AM, that are allowing people to artificially stretch their incomes. We're actually seeing home prices be relatively sustainable in terms of what percentage of borrowers are committing as a share of their income. So I think there's some strange aberrations today that will subside in the next 6 to 12 months. And generally speaking, I think a lot of what we're seeing in terms of home price appreciation today is really future appreciation that's being pulled forward.
Thanks
so,
very
Bob,
much.
I don't know if you want to provide your perspective.
I'll just mention one thing. I know for years we talked about the competition between multifamily and residential. And we had been talking internally that at some point, multifamily was so hot. We thought, at some point, folks are going to get tired of living on top of one another in an apartment type of arena and want some space from a single family home. I'm in that situation right now where I think I'm tired of apartment living myself. But we talked about as for that a long time. When is that going to happen? And we obviously didn't see the pandemic happen, but this is really playing out where it's shedding that shared sort of living space where you want to be near work, you're willing to share resources, elevators, common areas, and things like that. And the reversal has been seismic. So to the degree that returns, you may have a little more of a shift from maybe single family, back to multi. Not sure if it'll be in the big cities, but we're watching for that dynamic, particularly since there's a lot of construction going on in the multifamily space.
Thank you so much, Bob and Daniel, for your insights. We appreciate them.